As the global economy shifts towards sustainability, financial institutions are navigating the dual challenge of fostering environmental resilience while maintaining strong financial performance. Today, we're joined by global thought leaders, industry pioneers, policymakers, and innovators to explore how green banking is driving this change and redefining the future of finance. Welcome to our exclusive webinar, Exploring the New Era of Capital Management in Green Banking. For the opening keynote, we have Andrei Bogdanov, the CEO of Risk Insights.
Good morning, good afternoon, and good evening, everyone. It's my absolute pleasure to welcome you all to today's event, Insights into Capital Management in Green Banking. We will be talking today about transition to sustainability, green banking, and its critical role in today's world of finance, changes in the risk management models. As we gather here virtually, we stand at the intersection of two seismic shifts shaping the future of finance: the global transition towards sustainability and redefinition of the risks in the century of ESG. Environmental, social, and governance factors have evolved from being side considerations into central determinants of the financial stability and the long-term success. Events like climate-induced disasters, social unrest, and governance failures have demonstrated that ESG risks are not abstract threats. They are tangible, material, and capable of reshaping the financial landscape. Green banking plays a pivotal role here. By channeling financial resources towards sustainable projects, green technologies, and inclusive initiatives, financial institutions are taking on a dual role, not just as capital providers, but as catalysts for global change. However, this shift also demands a transformation in how we assess, manage, and mitigate risks. This is where innovation is critical. Institutions need to adapt advanced data analytics, AI-driven modeling, and scenario analysis to fully integrate ESG considerations into their risk frameworks. Doing so not only ensures compliance with emerging regulations, but also unlocks opportunities for sustainable growth. Today's discussion will explore how financial institutions are embracing these challenges and pioneering solutions. We'll hear from experts who will shed light on cutting-edge practices, the evolving regulatory landscape, and the road ahead for green banking and ESG-focused risk management. I encourage each of you to engage actively, share your insight, and challenge conventional thinking. After all, the future of finance and the planet depends on the bold ideas and decisive actions. Please direct all your questions and comments to info@riskinsights.co.za. Thank you all for being here and for your commitment for advancing the dialogue on the critical topic. Let's get started. Thank you.
Next up, we have Raul Vera Bogado.
Well, hello, Anushka. Thank you very much for your kind invitation to this webinar organized by Risk Insight. I feel very honored to share with you experiences about Paraguay's sustainable finance. First, I want to talk about a brief economic context of my country. We have a strong growth in institutions. Paraguay is one of the fastest growing economies in the region, supported by low inflation, an independent central bank, and a highly professionalized Ministry of Finance. It has a solid sovereign ratings. With Moody's, we have a BA1 with a stable outlook, and with Standard & Poor's BB+ with a positive outlook. We have a very competitive agribusiness. The agribusiness sector is free from subsidies, and it drives export-oriented growth. Among Paraguay's most important goods for trade, the country is the world's fourth largest soy exporter and ranks among the top 10 for beef exports. We have a renewable energy surplus. Hydroelectric dams form the backbone of Paraguay's sustainable energy system, enable significant power exports, mainly to Brazil and Argentina. The Itaipu Dam, operated jointly with Brazil, is the most productive hydroelectric facility worldwide. We have done forestry and conservation efforts already for a number of years. Paraguay is home to part of the Gran Chaco, which is South America's second largest forest ecosystem after the Amazon. Although economic expansion has traditionally posed challenges to deforestation, the introduction of a zero deforestation law in 2004 and recent conservation policies have enabled Paraguay to rank seventh globally in reducing deforestation according to the Global Forest Review. As of 2022, 44% of the country's total area correspond to forest cover, according to the Regulatory Environmental Agency. Focus on sustainability and finance, this context underscores the need for strong socio-environmental risk management to protect water, soil, and ecosystems. Sustainable development and finance play then a crucial role in supporting Paraguay's strategic economic projects and long-term growth. With regard to the early developments of Paraguay sustainable finance, the creation of the Sustainable Finance Roundtable was a regional pioneer. It was created in 2012 by four Paraguayan banks with support from DEG KfW from Germany and the Inter-America Development Bank. It focused on developing a socio-environmental risk assessment guidelines for agriculture, agribusiness, and livestock, setting the groundwork for integrating environmental and social criteria into credit operations. It was the first self-regulatory initiative in the Paraguayan banking system. It introduced minimum standards for sustainability self-assessment and diagnosis, paving the way for the Central Bank of Paraguay 2018 regulation that formally incorporates environmental and social risks into financial supervision. Among the most important achievements and contribution, we can cite risk analysis systems, implemented in environmental and social risk management framework with sector-specific guides for agriculture, agro-industries, and livestock and beef. We receive an international recognition for our collaboration with the Inter-American Development Bank, with the UNEP-FI and DEG. Since 2015, the Roundtable has been a member of the Sustainable Banking and Finance Network under the IFC and World Bank Group. In 2020, the Central Bank of Paraguay joined the NGFS, which is the network of central bank and supervisors for greening the financial system. And today, 100% of Paraguayan banking assets fall under national sustainable finance requirements, built on three pillars: climate risk management, ESG integration, and financing sustainability. With regard to recent developments, the current government has a robust sustainable development vision. In this context, the Ministry of Economy and Finance announced plans to embed sustainability as a cross-cutting priority in Paraguay's economic and financial policymaking. Furthermore, the Central Bank of Paraguay aims to strengthen the country and financial system's resilience to climate risks, aligning supervisory policies with global best practices. In 2024, broad agreements were reached with the International Monetary Fund, like the Resilience and Sustainability Facility, and the Inter-American Development Bank regarding new financial arrangements with binding goals. I would like to share also with you some thoughts about policy making with regard to the current environment and current scenario ESG scoring and sustainability finance is facing, not only in Paraguay, but worldwide. While regulatory bodies in Paraguay strongly believe in the importance of sustainable finance, they also grapple with debates similar to those in other regions concerning the scope, pace of implementation, and applicability of certain international standards. Some local businesses express concerns about the additional costs that may arise when adopting regulations designed for foreign contexts, and the effectiveness of these measures in achieving sustainability goals while preserving a viable economic return. This tension between the need to align with global frameworks and each country's economic and operational realities, Paraguay in this instance, underscores the importance of conducting an objective assessment of the feasibility, benefits, and potential impacts of proposed regulations. By doing so, the aim is to ensure that rules and guidelines remain sufficiently flexible and relevant to local conditions, while still upholding international environmental and social objectives. Over the past years, a growing number of financial institutions pledged support for net zero or decarbonization alliances, partly in response to increasing regulatory pressure and rising demand from environmentally conscious investors. Yet, alongside some large US banks stepping back from global net zero commitments, major asset managers such as Blackstone and Vanguard has also withdrawn from certain industry-led climate initiatives. These moves have sparked further debates on the credibility and cohesion of global ESG efforts, with critics arguing that such steps reinforce perception of politicization or greenwashing. Despite these headwinds, it is crucial to consider that the ESG movement has not lost momentum. Investors, consumers, and regulatory bodies across the globe generally expect more robust ESG disclosures and are increasingly aware of how environmental and social risks can reverberate throughout the financial system. While some institutions realign their strategies, overall awareness, data analytics, investors, and government scrutiny remain at an all-time high. Several US financial entities have cited concerns about overly restrictive or prescriptive regulations as a factor in their decision to exit certain climate focused alliances. Some stakeholders feel these initiatives impose high compliance burdens without providing enough clarity on how success is measured or how long term risk adjusted returns are achieved. Others have voiced apprehension that global coordination can lead to one size fits all requirements, overlooking regional and sector specific nuances. Rather than seeing these withdrawals solely as setbacks, they can serve as a catalyst for constructive dialogue. By closely examining the criticism and the root causes behind these financial institutions' decisions, regulators and market participants can first reassess regulatory stringency, determine whether current frameworks impose disproportionate costs, create uncertainty, or disclosures lacking materiality for certain business models. Second, address divergences in regional standards. Understand the extent to which EU, US, or other regional regulation may conflict or create contradictory compliance obligations. Third, enhance transparency in data and metrics. Work toward more universally accepted criteria, allowing investors to assess ESG risks and opportunities in a standardized, comparable manner without overwhelming complexity. Stakeholders and investors who support or have reservation about ESG alliances often share overlapping interest in long-term resilience and profitability. By engaging directly with critics and incorporating their perspectives into ongoing regulatory reviews, policymakers can draft guidelines that balance ambitious sustainability targets with the practical realities of capital allocation. This inclusive approach may strengthen credibility and encourage institutions to maintain or renew their ESG commitments. The innovations are playing a significant role. A standout example of progress, particularly in Africa, is the growing sophistication of ESG data and analytics offering. One notable firm is Risk Insights, based in South Africa. Among its achievements are data-driven ESG solution. Risk Insight is recognized for its proprietary ESG methodology preferred under the ESG GPS platform. This solution provides standardized, transparent, and replicable ESG scores for African markets, helping to bridge data gaps that historically limited both local and international investors from accurately assessing sustainability risks and opportunities in African enterprises. Regional expansion. The company has worked or expanding beyond South Africa, securing partnership in pivotal African markets such as Nigeria, a major hub in the continent's capital markets. These collaborations are evidence of the growing appetite for sophisticated ESG analysis across Africa, crucial given the region's diverse business environments and development imperatives. Collaboration with key stakeholders. Risk Insights has highlighted agreements with local stock exchanges, regulatory bodies, among other stakeholders. These collaborations are seen mutually beneficial since African firms gain access to robust ESG rating tools, while investors, local and foreign, obtain more reliable insights into market specific sustainability factors. Addressing African specific challenges. Africa, like Latin America and other regions in the world, facing unique ESG hurdles, from climate vulnerability and infrastructure deficits to social development needs. Localized ESG rating frameworks, like those Risk Insight develops, tend to account for these regional nuances more accurately than generic global-only standards. This ensures a fairer representation of both opportunity and risks in African markets while still aligning with broader international ESG standards. Balancing divergent views while advancing global coordination. The diverging path taken by some US-based institutions and the robust regulatory drive in regions like the EU and increasingly in parts of Asia and Latin America, as well as in Africa, underscores the fragmented nature of current ESG policy. Yet, African success stories such as Risk Insights demonstrate that ESG initiatives can flourish. To steer toward convergence, policymakers and industry leaders might adopt the following aspirational yet pragmatic approaches. First, global local synergy. Foster cross-regional dialogue that incorporate best practices from both developed and emerging markets. This local perspective ensures that ESG frameworks remain relevant to local conditions yet upholding international standards. Second, facilitate transparent and standardized data. Emphasize data sharing platforms and collaborative rating methodologies. Organizations like the International Sustainability Standard Boards and regional rating agencies, including Africa-based ENG data providers, should coordinate reducing inconsistencies that undermine global comparability. Third, to promote trust and depoliticization. Present ESG not solely as an environmental or social ambition, but as a fundamental risk management and value creating strategy. Depoliticizing this initiative can mitigate concerns among skeptics who view ESG frameworks as too ideologically driven. Fourth, leverage successful regional examples. Highlight positive case studies such as Risk Insight in Africa to showcase how ESG-oriented innovation can drive both investor confidence and development outcomes. Success stories often inspire other regions to adopt similar frameworks. Fifth, stay the course through the market cycles. Recognize that exits from alliances or changes in membership do not necessarily reflect a permanent retreat from ESG. Market and political cycles can shift, but long-term structural trends, that is, climate change financial implications, persist, prompting resilient ESG solutions to endure. 6. Refine regulation through minimal engagement. Seize this moment to gather stakeholder feedback, especially from institutions voicing recent concerns, to refine global and regional ESG frameworks. A regulatory environment that accommodates genuine market complexities and encourages constructive collaboration can help maintain forward momentum. As conclusion, we can say that while the withdrawal of certain large funds and banks from net zero alliances introduces uncertainty, the momentum built over the past few years, backed by investor awareness, regulatory evolution, and local innovation, remain robust. By recognizing the strides taken in ESG and green banking and remaining mindful of recent challenges and divergent viewpoints, we can forge new paths of consensus that reinforce the resilience and efficiency of capital markets worldwide. The ultimate goal is a future where public policy, private initiative, and stakeholder collaboration advance both sustainable economic growth and minimal risk mitigation on a truly global scale. Through sustained dialogue, collaboration, and learning from successful regional examples, the global financial community can continue to advance ESG scoring and risk mitigation to benefit investors, societies, and the planet. Thank you.
Next up, we have Maxime Bove, Head of Strategy and Risk at Fusion Asset Management, who will be discussing the topic of macroeconomic impact on capital management.
Hello, my name is Maxim Buyev. I'm a professor at New Economic School in Moscow, and I'm visiting scholar at St. Anthony's College, Oxford University in the UK. But today I'm talking on behalf of the Fusion group of companies in London. I'll be giving you essentially an introduction and a view of the topic in relation to our approach to modeling climate risks, be it transition risk or physical risks. And Kirill Ilinsky, my friend and partner of more than 15 years, will be talking more about the specifics of the modeling of those risks. And I should say that we are not only academics. We did publish academic work, and one of the things that we published 4 years ago, a book on history and philosophy of financial modeling, has become a bestseller in Russia. But we also have jointly about 50 years of experience in the financial sector, and we've been doing a lot of work in asset management, risk management, modeling, consulting for financial institutions, banks, multinational corporations. More recently, we've been working on modeling and accounting of climate risks in credit risks of counterparty, and we consulted a number of banks in relation to that. This is something that classical Greeks would call literary topos, or stylized facts. If we look at the number of years over the last 50 years, you can see that there is a clear trend for the increase in natural disasters of various natural disasters by different causes. And on the one hand, this tendency is clearly a reflection of the fact that we have more data. We have learned how to analyze the data, and so there is a better account of natural disasters specifically in the data itself. But on the other hand, this is a reflection of climate change, and I'll be speaking about that a little bit in detail later on. And what's important is that there is a significant increase in the number of natural disasters worldwide. So this is not specifically for one particular country, but it's a worldwide phenomenon. And obviously, overall, taking at the macroeconomic level, this is a huge problem for the government, because government will have to, or governments have to already deal somehow with the consequences of the realization of this natural disaster risk. But we sort of zoom in this particular presentation, we zoom in various agents and specifically banks and how banks face this problem. So basically, overall, if you aggregate this problem up to the level of the state, this becomes a state problem. But first of all, let's look at the banks. So in the next slide, we see not only the number, it's like a different source. It comes from the website, which is called Our World in Data, which is used, which is very popular about different media and politicians and academics as well. It shows us more or less the same tendency to the increase in the number of physical risk realization, natural disasters, but it also shows us the extremity that it's not only the number of natural disasters that increases over time, but the extremity. So it's not only the frequency, but also the amplitude. And we see that extreme weather starts happening more frequently, extreme temperature starts happening more frequently. And this is another realization of the problem, another side to the problem. So this is the realization of climate risks as a way, and in a way. And speaking from the perspective of financial theory, climate change is thus a new background risk, a type of background risk or systemic factor. What that means? What it means is that you cannot diversify that way in the portfolio. So you have to find a way of modeling that risk. This is a new factor of systemic factor of risks. And if you speak about transmission channels in relation to the banks in particular, so that background factor, that systemic factor of risk affects banks via the credit channel or credit risk and market risk. We can also speak about the effect on liquidity, the effect on operations, but we essentially in this presentation, we leave those out. So essentially we'll be speaking only about the credit risk channel. That's very important. And obviously in the market, there are many service providers that concerned with specifically market risk and how the realization of climate risk affect the pricing of financial instruments, be it bonds, shares, different types of financial securities. So the next slide gives you a very interesting diagram, a picture that we borrowed from the publication by the Bank for International Settlements. It basically gives you the some sort of now widely used breakdown of climate risks into physical and transition risks. And these are the two primary types of risks. So the physical risk is essentially a risk of physical damage. We see that almost every day nowadays. And we more specifically can talk about the acute risks like fires or floods or chronic risks that sort of increase but gradually. So they do not happen all of a sudden as acute risks. But one way or another, they affect the economy via microeconomic and macroeconomic transmission channel. What it means, basically, what does it mean? It means that, say, households or companies, they have some assets, and due to changing climate conditions, due to those natural disasters like typhoons, hurricanes or floods, there will be damages happening more frequently and more severe damages to those assets. And this is basically a macroeconomic channel, how climate change affects the assets of economic agents. And then you have macroeconomic channel. And this is how all those damages happening at microeconomic level, how they aggregate up to the level of the national economy. And this is one way of looking at sort of macroeconomic risk. Another way of looking at could be the following. Essentially, if you don't speak about the banks, but you look at the economy and you say there are insurance companies. Insurance companies basically are at the forefront of facing climate risk because they insure properties. But the problem with climate change is that first, as I said, natural disasters start happening more frequently and they're more severe. That affects insurance companies because they start losing money more frequently, and they have to, in response, either to raise the premium, so the they protect their clients at a higher price of risk. And on the other hand, they may completely withdraw from the market. And this is what we already witnessed in several states in the United States in response to the increased frequencies of forest fires or hurricanes. If you look at Florida, for example. And there is another problem is that there is this notion of insurance protection gap. That means basically not all the properties in the country may be insured by insurance companies. And that gap is quite substantial, up to, well, it's actually more than 30% in developed countries. And if you look at developing countries, the insurance protection gap it's in the amount of about to the degree of 90+%. So most of the properties will not be insured in the country. So again, but an interesting perspective from the insurance companies is that if you look about insured risks, physical damages, that's a kind of first degree problem. But the second order degree, which is not insured at all, second degree risks, is that, say, you have a damage to damage to assets of a company, but then the damage to that asset may disrupt the functioning of that company, and that will translate through the whole chain of value-added chain where the company sits somewhere. And this, so it's more appropriate to talk about economic risks, and this is kind of second order, also macroeconomic risks, so how physical damage risk disrupts the economy. And so this is something we also love to talk about, love to incorporate in our approach to modeling. So then if you move from the left to right, so basically why those two transmission channels, physical risk translates into financial risks, credit, market, liquidity, and operational, as I already said, but we are focusing on credit risk. And basically, well, what's happening with the insurance companies, as I've said, what it means for the banks, that previously banks would rely, well, I mean, not directly, but would say in economic sense, if you take the economy as a whole, they would rely on insurance companies to take up, basically to face those risks in the first place. But with severity and frequency of natural disasters happening, banks have to deal more and more with, especially because the insurance protection gap is increasing, because insurance companies either withdraw from the market or make their services more expensive to their clients. So banks will have to deal with those risks. So we have to take into account the effect of this tendency in the insurance sector. This is like part of the problem. This is when we call that's when we talk about the physical climate risk. Another type of risk is transition risk, and transition risk is essentially the risk of changing in government policy or technological frontier, or sentiment of investors or consumers. So something happening with the regulation of the economy, or something happens with how different agents behave in the ecosystem or in the economy, and that affects the bottom line of the companies. That affects their profitability. So, in particular, if we speak about the current agenda of greening the economy, making them greener, basically you start thinking about whether a company is green or brown, and what are the approaches of actually thinking or measuring the greenness of the company. And if you say green, then you're okay. If you're brown, you're not okay. And that basically translates into also into the risk, which is directly related to climate change and political agenda. But it must be said here that this transition risk is nothing new. Say a few years ago, Condoleezza Rice and Amy Ziegert published a book on political risk in 21st century, and how different agents or different tendencies in politics, in the economy or elsewhere and geopolitics, how can they affect the profitability of the companies? And so transition climate risk is essentially just one of reincarnations of these political risks. So in a way, it's nothing new. In a way, it's an old problem, but it must be modeled. And we also look at this type of risk in our approaches. So as I said, like there are two different types of risks, and this is like they represent different challenges for banks. Now, how would you go about modeling those risks? Let's look at physical risk. Obviously, one of the problems, because like we are concerned here with the physical damage to assets of borrowers, so you need to map physical assets to borrowers. It's one particular problem. Then you need to describe weather events, how the distribution of extreme events of natural disasters changes in time. So climate change implies that the distribution shifts to the right in a way, like as I said, like the frequency, the average, the mean of the distribution shifts to the right, natural disasters become more frequent. But at the same time, the tails of the distribution become thicker. So the frequency of extreme events increases. So the third thing is description of damage. So you suppose you manage to model the distribution of critical climate events pretty well. So what happens next? Then you need to know how the particular structure, particular physical assets respond to this extreme natural events. Say, if you had a flood or a fire, how would that affect a building which is made of wood, or made of brick, or made of concrete? You need to basically, in practice, you need structural engineers who would answer that question. And this is all in relation to a particular asset or particular item or particular name, a client vis-a-vis a particular bank. But then for the bank, a much bigger problem is actually to account for correlation or dependency effects across different clients. Because if you basically concentrate your business in one particular geographical area, then climate disasters imply that your effects amplify and have like amplification effect on your banking book. On the other hand, if you try to diversify geographically, you're a multinational bank. In that particular case, there is some degree, although it's still background risk, but there is, because the realization of this background risk differs in different geographical locations. So you have some scope for diversification in that particular case. So it's very important to think about correlation effects of the banking book. And this is also one of the things that we'll have to take into account when we approach the problem. Then on to transition risks. So as I said, well, probably not said, but mentioned, so you need some sort of like a measure. What's the measure of particular political risk in this respect? And obviously it's CO2 emissions. And then you can talk about different pillars of disclosures on ESG risks. Then you need to think about how you can think about taxing CO2 emissions. You can think about trading CO2 emissions. And then you can think of how that affect changes in your cost base, how that hits the revenue. If you have, due to political risks, if you have any stranded assets on the balance sheet of a client. So if you say an oil company and you invested a lot in an oil field and you thought about earning lots of money on extracting oil from that oil field, but because you're brown and you would not be able to develop your business as extensively as you previously thought, then basically that particular oil field becomes a stranded asset. Then you can think of different mitigation measures. In particular, like again, you can trade probably you can trade CO2 emissions or carbon credits and so on and so forth. So that everything that may or can be modeled. And this is also something that we think in our approach to modeling climate risks. So the transition risk is actually something that most widely discussed in banking sphere. So the modeling of physical risk is a much more formidable task as it currently stands. But transition risk, say, if we concentrate for now on transition risk, is something which is connected to ESG reporting, and what is very important in relation to transition risk is that we need sustainability data from the company, and how the company cope with ESG agenda. And this is essentially, historically, this is how Fusion Group started working together with Risk Insights, leveraging their knowledge of sustainability metrics in relation to African companies and our knowledge of approaches and ideas how to better incorporate transition risk into modeling credit risk in the banking sector. So this is all for my part of presentation. So now I'm passing on to Kirill Ilinsky, who will be speaking more about the details and specific of modeling both the physical and transition risks at the Fusion Group. Thank you.
Next up, we have Kirill Minsky, founder of Fusion Asset Management in London, presenting an academic review of Basel and ESG.
I am Kirill Ilinsky. I run Fusion Group. As Maxim said, we advise clients primarily in the UK, but we also run portfolios, and we advise corporate clients with regard to economic risks. And recently, when I say recently, it's actually from 2018, we started looking at climate-related risks for corporates and then banks. And when we were tasked with a way to account for climate risks in probability of defaults, and then it rolled into the portfolio construction, and that's exactly what we're going to talk about today. Physical risks. What are the requirements for accounting for this risk in general corporate, but we're specifically talking about banks. So first of all, when we account with risk, we don't want to change everything which bank done so far. Meaning that everything which we're going to add, it's going to be on top of what banks have already in terms of systems, in terms of internal modeling, in terms of communicating with regulator, in terms of calculation of regulatory capital, in terms of accounting, capital charges, and calculation of internal rates of return and interest rates. So this needs to be on top of what already exists, not instead of. And that's a very important bit, meaning that we need to find a way to account for climate risks and calculating of probabilities of defaults on top of the existing models. And then we need to look at how we, with the new borrower, we add the required capital, and that's not going to be changing all the Basel based models, but rather see how we can account within the existing models this additional thing together with the additional correlation. And then we need to look at how after this we need to think in terms of difference in charging of different companies with different exposures in the way it is done now, but with new capital charges and new level of correlation. So basically, what is the rate? This webinar is called Green Banking, but if you think about it, there is no green banking. I mean, that I came from trading. I've been trading 25 years, and I came from trading. So I think you can charge interest if there is risk. You need to qualify the risk, and then you can qualify the interest. There is no green banking. There is banking. Banking is when we lend money proportionately to the risk we take. If we know how much more risk or less risk for that extent we take, that much we can change the interest which we're charging. If we don't have a measure of how much risk changed and we're just reducing the interest, that's effectively sponsoring green firms at expense of bank shareholders, even maybe if we don't know this. So accounting, quantitative accounting of physical and transitional risks in probabilities of defaults in overall banking book is the basis for sustainable banking business model. And what we're trying to do is literally do exactly this within the framework of existing banking business model. Slide 11, please. Let's first go through methodology of what we're trying to do, an example of physical risk, and then we will look at transition risks as well. But in a physical risk, in a certain sense, although it's more tricky to do physical risks, but at the same time it's more intuitive, and that's why I want to spend a little bit more time on physical side, because here we will develop the intuition. So first of all, we need to understand what are the factors which are affecting physical damages. That would be probably wind, that would be probably flooding, that probably would be other things. We will have a look at them. Imagine that you have a list. Then we need to think on the level of the borrower. We need to map the assets. We need to qualify the assets with regard to damage from the factors which were done on the stage 1. Then we will find probabilities of default. These probabilities of default, why it's said here, changed ratio of probabilities of default, because we will be aiming to find a ratio between new probabilities of default together with the climate risks to the probability of default before the climate risk. And then we take this ratio and multiply by probability of default calculated within the existing banking models. In this way, if we now put climate risks back to zero, we're coming back to the existing banking models currently in use. So therefore, that's the principle of add-on rather than substitution of already existing the bank. Therefore, we're aiming to create a minimal impact in terms of banking operations and banking business model when we're trying to account for transition risk and physical risks. When we have a look, when we get already all the list of all the borrowers, we recalculate probabilities of default. Now we need to understand how we work together, how they interact, because there is a correlation. We know from the Basel framework, from single factor model, that you need to account for dependencies because in the probabilities of default to calculate really required capital and regulatory capital, and also the economic capital which is required by the bank itself. At this point, we will know how capital changes with every new borrower added, which means that if we know the internal rate of return, the required rate of return on the capital used, we then can calculate the interest required for that particular loan added to that particular loan book. Which means that at this point we have risks working together within the banking book. We know consistent level of interest consistent with the risks and with the banking model which we need to charge. And then we can think about ways of mitigating or hedging out the risks of the capital and basically think about optimal use of the banking capital, exactly the same way as we done with credit before. So that's the outline of how we do things. We need to map the assets of the clients, of a particular borrower. This can be done in many different ways. You can do it in a complicated way with geographical locations, and then obviously you can use different systems to estimate quality of the assets. But ultimately it's coming to, you have asset in a particular geographical point. That asset is exposed to 2, 3, or maybe one of main climate factors, and you need to say, depending on the climate strength impact, this asset will suffer that amount of damage. So what are the typical factors, climate factors? Floods, winds, rain, wildfire, droughts, hail, we all know them. In certain areas, the main factors actually the permafrost melt rather than anything else. And obviously temperature anomalies, extreme heat, and everything which follows from it. We need to think what is the effect on the asset of the borrower from this factor in this particular point. And that's what we map as damage functions. On the right-hand side of slide 14, you see the set of upsloping curves. That's the percentage of damage of the asset for a particular strength of the climate factor. In this case, it's flood depth. What you see is that wooden houses with 1-2 stores, they will suffer damage very quickly, and after a certain level of depth will be basically destroyed, so will be written down to zero. While at the same time, brick houses and block houses with 4 stories, that's a green line here, will be considerably more stable. So not only you need to know where the building is standing, but also what quality of the building. And in principle, exactly like Maxim said, building of these curves requires structural engineers to be involved and so on. However, if you think about this on the level of total portfolio, specifics of a particular building is not that important. What you need to know is how the assets are split in relatively treatable tiers, and then treat them according to the empirical curves which are accumulated for all the damage functions and type of climate factors. So what we done so far, we mapped the assets and we said if there is a wind or if there is a flood, how much of the asset will be lost. And here we're not talking yet about the second order effects which Maxim mentioned in the terms of economic damage. We're really looking at the losses to the assets. How then this loss of the asset will translate into probability of default? There are several models to do that. The one which we've been using, and since we came from credit and credit trading and capital structure, that's a standard model in that part of the business. It's called structural models. If we think about balance sheet of the company, so it's based on Merton model. There is a different type of structural models which are linked to Leland, and when we look at the modeling EBITDA stochastically rather than modeling assets of the company stochastically, but ultimately we all the same type of a model. Let's look at very, very simple example of Merton model. You have balance sheet of the company, and this balance sheet is split between equity of a company and assets which were funded through borrowings. So if you look at the right hand side of the on the left hand side of the slide, you see the assets. There is a red line here which is a default point. That's a separation between equity and debt. While assets not touching default point, so assets did not fall to the level where they start touching debt, we are fine, meaning that company can repay the loan and credit event hasn't happened. However, if there is a volatility, meaning that this glass with water is now shaky and the level of water now touching the red line, meaning that from time to time assets going below the level of debt, it means that in principle that's a credit event. We're putting the climate factors into the process for the assets. We're finding the factor gamma, which is a ratio between probability of default with climate and without climate, and then we use this factor gamma to multiply the existing banking probability of default, which is coming from internal banking models. And we say that now we have set of probabilities of default which both account climate risks and converging back to the previous one when climate risk is ignored. The next step, it's a step when we need to think now. We have multiple set of borrowers. yes, we calculated probabilities of default for each one, but how they interact together, because only interaction, correlation between the defaults really define the required banking capital. And for that, we need to think back to how it was done previously. And previously, let's speak in the spirit of Basel. So we need to think what will be the analog of correlation. So you have a standard correlation which is driven by economic factor in Basel framework, and you now need to think about additional factor which is driving probability of defaults and responsible for climate. This is done in our recent article, which we done with our colleagues from Bank of International Settlements, and which will be in public domain very soon. But basically, it deals with the calculation of required portfolio adjustments in the case of updated probabilities of default in case of including the climate. That's the step where we calculate together probabilities of default on the level of portfolio, and we see how unexpected credit loss on the portfolio level changes together with including climate risks. In simple terms, the model which we developed satisfies the so-called invariance principle, meaning that every new loan is actually accompanied by additional piece of capital, and you don't need to recalculate the whole banking book again. In this regard, it's a practical solution which is similar to previous, effectively Pillar 1 Basel main formula. In this case, you have additional add-on factor which is responsible for damage in the recovery in case of default, and also additional probability of climate event. So at this point, we described everything which needs to be done with regard to physical risks. Mapping of the assets, okay, that's not an easy problem, and there are easy solutions, meaning talking to the borrowers, asking them to map the assets, then putting on top a set of empirical curves which are calibrated for every country, for every type of the asset, and then running the Merton model, and then going to portfolio. At this point, you calculated the capital. When you calculated the capital, you then can move to economic analysis, meaning that if you have required rate of return on the capital, additional capital translates into the required rate of interest, which you are charging on the borrower. So that's a general description of the scheme. Now, this one is intuitive. We understand the assets, we understand the damage, we understand the probabilities of default, we understand the portfolios, we understand the correlation. That's basically what we tried to achieve talking about physical risk. Let's now move to transition risks. Now let's think about transitional risk, which the main subject of conversation banking community so far. And if you look at the stress scenarios, that's primarily done on the transition risk. We use the same logic as before. Once again, we need to figure out which factors affect dynamics of the assets. And in this case, obviously, if we think in terms of the modeling of EBITDA rather than modeling of asset itself, we think about revenues that can be driven by changing consumer preferences, changing market conditions. It can be changed, can be challenged in terms of changing regulation and potential continuation of the sales open to litigation. So revenue is affected by these political risks. Then there is a second component, that's costs. How much production costs? So energy prices, carbon taxes, cost of sales, you can include here litigation as well. And then you can move to supply chain. And supply chain, once again, open to this transition risk. That's why you need to understand how, in case of litigation or in case of disruption, the supply chain will be changed. What's the increase in the costs of substitution? And that's really, really tricky thing to do. So it's very important when you're mapping the factors which are affecting the asset dynamics to have the data which has not been till recently available, because people simply did not ask about it, because they didn't know how actually it translates into the future risks. So what our colleagues from Risk Insights done for listed companies and non-listed companies, and particularly interestingly for mid-sized companies, they build up a framework where collection of data required for ESG ratings can be translated into modeling of assets and EBITDA of companies, and therefore calculating additional impact factors for the probability of default stochastic model. So we account for these factors. We calculate once again probabilities of default together with these factors and without these factors, and we find factor gamma, which then would be able to use on the level of a single company on top of already existing internal banking model or rating model, which is available already to calculate probability of default. So once again, it's a principle of add-on rather than substitution of existing business. We need to think in terms of, so we get the data, we see the modeling of the asset process, we calculate probabilities of default with these factors, we calculate the ratio of probabilities of default, therefore we see the transition between two, and then we move to calculating on a portfolio level of expected and unexpected credit losses, which then translate into the required capital, and then translate into the interest, regulatory capital, and ultimately rate of return on the equity. When we're calculating the unexpected credit loss, once again, we're using the model which we recently developed, which is slightly more complicated than physical model, funny enough, because in case of transition risk, broadly speaking, there are not two scenarios. Hurricane happened or not happened. But actually in transition, there are three scenarios. Orderly transition, disorderly transition, nothing happened. So mathematics is a little bit more interesting. Calibration is a little bit more interesting, but at the same time, it's very close logic in terms of general picture to what we've done for physical risk. But ultimately, it translates to updated formula for unexpected credit loss, once again with invariance principle, meaning that every new borrower will come with additional level of the capital. Once again, consistent calculation of risk, and that's exactly where we start talking about green banking. So you take the company, which is green and doing good and not using much energy and not polluting and so on. Why we need to charge less interest on this company? Not because it's a great company and it does public goods. No, it's actually because of the factors, probability of default coming from transition risk is actually less than probability of default before it. Yeah, on the level of whole banking book, which means that it requires less regulatory capital on the level of the whole banking book, which means that it can be attracting lower interest, and that low interest really translates into the supporting the green economy and green transition. So hopefully this very, very brief introduction into this logic gives you an impression of how we do things. It's generally, of course, everything is more complicated than it sounds, but at the same time, it's a very simple logic, and very simple logic helps as a guiding light. As I said, we came from trading, and actually from derivatives trading. And derivatives trading is very complex, multiple assets, difficult correlation, and so on. But in 1970s, and derivatives existed for 200 years. But in 1970s, two guys, actually three guys, Merton, Black, and Scholes, invented a framework which became, it's not exactly correct in every respect, but it's a very simple, intuitive, if you like, benchmark model with regard to how risks of a particular derivative books move. And this model helped enormously in terms of developing of the business, scaling up the business, and sustainability of the business. So what we're trying to do now, we're trying to say, look, we developed a model which is effectively a benchmark model which allows quantitatively define risks coming from physical and transition risk. That requires data, as always. So we, together with Risk Insight, now marrying analytical framework and access to unique data sets to create the benchmark models, which you can then make more complex, you can make it more tailor-made, you can be very exact as always. But it's a benchmark model which can be as complicated or as simple as you like. And they are very happy to work together with Risk Insight to bring it to Africa. And I hope you will have questions, please come back to our colleagues from Risk Insight, and we will be able to hopefully promote the things together. Thank you.
Up next, we have Dr. Alexey Lobanov, Senior Consultant at Fusion Asset Management, who will be discussing integration of proposed solutions with banking risk systems.
Ladies and gentlemen, my name is Alexey Lobanov. First of all, I would like to thank Risk Insights as the webinar provider and my colleagues at Fusion Group for the opportunity to speak at this event. We will have a quick look on the regulatory landscape to elicit what central bankers and financial regulators expect from banks in terms of managing climate risk and how this could be achieved in practice. Banks have been highly regulated financial institutions, and so it's important for us to know what their regulators think about climate risk. Let me start with the Basel Committee on Banking Supervision, that is a well-known global standard-setting body for international active banks. In 2022, issued high-level principles for the effective management and supervision of climate-related financial risk. These principles are aimed at both banks and their supervisors. One of them explicitly states that banks should understand the impact of climate-related risk drivers on their credit risk profiles. Banks should also ensure that credit risk management systems and processes consider material climate-related financial risks. In practice, this means that bank supervisors treat climate risk as potentially material for banks with global presence. Moreover, they expect that banks should recognize and account for climate risk across all stages of credit risk management process, from pricing and loan loss provisioning to capital allocation and performance measurement. Later that year, the Basel Committee published frequently asked questions on this topic that covered all major risk types, including credit, operational, market risks, and liquidity risk. Speaking about credit risk, the committee urged more sophisticated banks using internal ratings to consider in a conservative way climate risks in their estimates of probabilities of default, losses given default, and exposures at default. In other words, banks are supposed to have internal models in place to adjust their credit risk drivers for climate risk factors. At this stage, the Basel Committee has not prescribed any methodology how this could or must be done, thus allowing many degrees of freedom for the industry. We're here to propose innovative solutions for banks to let them measure and eventually mitigate their exposures to climate risk. So far, we've spoken about supervisory expectations. It's now time to say a few words about regulation of climate risks for banks. Another international body, the Network for Greening Financial System, in its latest publication has turned to adaptation to climate risk after focusing on its mitigation over the previous years. The NGFS believes that climate risk merits recognition in transition plans, investment decisions, climate change scenarios, and, most importantly, in regulatory frameworks for banks and insurers. It also admits that the current understanding of the impact of climate risk at the level of individual credit exposure is not sufficient for designing proper regulation. Turning to risk weights used in regulatory capital calculations, the NGFS thinks that they can also be reduced in response to measures enhancing resilience of financial institutions to climate risk. However, this should not be done at the expense of safety and soundness of the financial system. In sum, the international bodies think that risk assessments used in financial regulation can be adjusted both upward to expect higher credit risk due to climate change and also downward to recognize resilience measures taken by banks' counterparties to adapt to climate risk. New Zealand can serve as a good example of advanced regulation of climate risk for mortgage lending. Four largest banks using the internal ratings for calculating regulatory capital to cover credit risk are urged to recognize short-term climate risk through loss given default. Banks working on the Basel III standardized approach should recognize the impact of climate-related events on residential properties values under the internal capital adequacy assessment process. For non-residential mortgages, banks should rely on the judgment of credit agencies about the materiality of climate risk for individual exposures, affecting their credit ratings and consequently risk weights. This framework is underpinned by an in-depth regulatory stress testing to flood damage at the level of an individual asset. It should be noted that reality is much more complicated and diverse than even the most sophisticated rules. These recent cases show that climate risk amplifies financial risk and incurs losses to banks in multiple ways, from financial relief measures such as loan restructuring and waiving penalties to early termination of term deposits and reduced rates on new loans. Here we see an interplay of credit and liquidity risk induced by the manifestations of climate risk that could be really dangerous for a bank. Finally, let me present our view on how a bank can upgrade its risk management system to account for climate risk. We start with enhancing internal credit ratings used by the bank with our climate risk model for a single obligor across all major business lines. This enables the bank to adjust its estimates of probabilities of default and losses given default at the borrower level. This is key for adequate loan loss provisioning and also for controlling residual risk resulting from collateral management. Next, we develop a credit risk model on the portfolio level to account for correlations of defaults caused by systemic climate risk factor. This model is used for allocating economic capital down to business lines, products, and customers. This in turn enables the bank to price climate risk and take it into account in risk-adjusted performance measurement. As I've shown before, this approach closely aligns with the current and emerging regulatory frameworks, including the Basel guidelines. Ultimately, climate risk adjustments should be embedded into all major processes of risk management, including risk appetite, ICAP, stress testing for all material risk types. After all, banks need to mitigate the climate risk component of their loan and trading books by way of insurance and hedging with derivatives. Thank you very much.
Next up, we have Dr. Mao Jun, who will be discussing progress and experience sharing in China's sustainable green banking and capacity building.
My name is Ma Jun. I'm the chairman of China Green Finance Committee, which was set up by the central bank, namely the PBOC, back about 10 years ago. And I also have a couple of other positions in green finance related institutions, including being the president of Institute of Finance and Sustainability, and also the chairman of Capacity Building Alliance for Sustainable Investment. Today, it's my great honor to have the opportunity to join this conversation on green banking. And I'd like to take roughly 10 minutes to talk about green finance development in China, which really started about 10 years ago, and also some of the international cooperation mechanisms that China has been deeply involved. Now, let's start with the origin of Chinese green finance. Back 10 years ago, that was 2014, when I joined the central bank as a chief economist. We began to think about the need to develop the green financial system. At that time, the trigger was largely air pollution. As some of you know, China had, I think, 7 out of the 10 most polluted cities in terms of air pollution in 2013, 2014. And there's a massive demand for financing projects which are reducing air pollution. Of course, water pollution, land contamination was also a very serious challenge to the environment. So at that time, I was leading a team in the Chinese Central Bank. When we designed the sort of a strategy for green finance, we stated to the central government that we need to mobilize roughly 4 trillion RMB every year to deal with pollution. But the fiscal system, namely the central government's fiscal authority and local government fiscal bureaus, can only mobilize 10% of the money. And that's why green finance becomes so important, because it mobilizes 90% of the financing that's needed to deal with pollution. And that was the origin of Chinese green finance. And subsequently, in 2015, our proposal was adopted by the central government. And we were given the mandate in the central bank that we need to organize 7 ministries to jointly develop a framework or guideline for green finance. So I spent roughly 1 year between 2015 and 2016 on drafting the green finance guideline. By 2016, the guidelines were officially out. And since then, which is about 8 years already now, we have now developed the largest green banking market in the world. And the Chinese green loans extended from the banking system is now about 37 trillion RMB, close to about $5 trillion. And also we developed the largest green bond market. The outstanding amount is about 2.2 trillion RMB. And under this framework, we developed what we call 4 pillars that make the system functioning. One is taxonomy. In the very early days, 2014, 15, we began to draft the taxonomy, which is a definition of green banking, green bonds, and other green financial instruments. And over the past 10 years, we have developed 3 sets of taxonomy, one for green lending, one for green bonds, and one for green projects. And this taxonomy has many usages, including defining and labeling the green products, and also allocating incentive, because the governments and also the central bank has some incentive to give to those financial institutions which is doing better than others in terms of green financing. So we need to measure the outstanding amount of green loans and percentage of green loans in total loans. So these are the figures which we base the allocation of our incentive, including cheap financing from a central bank and government subsidies for green loans. The second pillar of the green financial system in China is disclosure requirements. We started in the early days to require the corporates which receive green loans and green bond financing to report environmental benefits. Namely, if you reduce the air pollution, water pollution, land contamination, then you have to report how much you have done that. And if you reduce carbon, tell us how many tons of carbon you have reduced. Of course, recently we have moved towards a corporate or entity-based disclosure system, which is largely aligned with ISSB International Sustainability Standards Board requirement. Disclosure is very important because it connects the investors with the green projects, with the genuine green projects. Without such information, it tends to lead to greenwashing. The third pillar in the Chinese green financial system is what we call a suite of products. We realize that relying on one or two products are not enough because the economy is very diverse. We need sometimes long-term green loans, sometimes short-term green financing, sometimes green insurance products to hedge against certain risks, and sometimes equity financing, which can tolerate risks. So over the past 8 years or so, we have developed, as I said, the largest green lending market, the largest green bond market, and we now have 1,000 green funds which are offering equity investments in green projects. And also we have a few hundred types of green insurance products which are used to hedge against the green production related risks. Now, moving on to the fourth pillar, which is also very important. This is what we call the incentives. Why do we need incentives? Because a lot of green projects in the earlier stage are not making enough money. Their financial returns are not high enough to attract private sector financing. And that's why incentives are needed in the earliest stage of these projects or industry development. That's why we designed various kind of incentives to enhance the returns of these projects so that they can mobilize participation of private sector financing. For example, the central bank in China, namely the PBOC, has introduced the decarbonization facility, which offers a low-cost funding facility through commercial banks to green projects. They covered about 20 types of green projects, including renewable energy such as wind and solar, biomass, and energy storage and so on, as well as industrial decarbonization plus CCUS projects. For these projects, they can receive funding from the central bank at a cost as low as 1.75% per annum. And at the local level, a lot of local governments using their fiscal resources to subsidize the green loans. For example, in some of the pilot cities of green finance, they offered about 50 basis points interest subsidies for green loans. This means that for a loan which originally has an interest rate of 5%, the company only needs to pay 4.5. The rest, which is the 50 basis points, are paid by the government. So these incentives really drive the rapid growth of green financing in China. On average, last few years, the Chinese green financing growth rate was about 20% per year. In some of the pilot cities, they were growing at 40% every year over the last 7 years. And in the best green finance pilot city, which is Huzhou, they are now having a green ratio in the banking system of 34%, which is 34% of the total loans are green loans. They are consistent with the taxonomy. And this ratio, 34%, is about 10 times higher than many other developing country emerging markets. Now, let me just say a few words on international cooperation. We, in the early days, as early as I think in 2015-16, realized that green finance, being part of the global environmental agenda, especially for fighting against climate change, has to be an internationalized effort because a lot of efforts are generating global benefits or positive spillover effects. That's why collective efforts, coordination, collaboration become so important. And in 2016, China launched the G20 Green Finance Study Group when China was the presidency of the G20. And I had the honor to co-chair this group from 2016 to 2022. And during the process, the group was upgraded to the Sustainable Finance Working Group under the G20. And this platform became a very important sort of a coordination mechanism for many international organizations. And every year, the G20 hosted the dialogue between all key players in the international community on green sustainable finance to develop their strategies, to coordinate the actions, and to develop roadmaps for future actions. For example, in the last few years, the G20 Sustainable Finance Working Group came up with the roadmap for sustainable finance growth and also published the Transition Finance Framework in 2022, which is now becoming the guide for many countries' adoption of transition finance. Another effort we're making is to promote the harmonization of green finance standards. This was initiated about 4 years ago between China and Europe. We launched a IPSF working group on taxonomy. The backdrop is that a lot of countries are beginning to develop the taxonomy to define green sustainable activities in their own way. But if the hundreds of taxonomies defining green in different ways and they're inconsistent with each other, then it becomes a problem for cross-border green capital flows, because if a green bond, for example, issued in China cannot be sold in another country if the two countries are using different taxonomies. And that's why back 4 years ago, we began to explore the options to harmonize these different definitions. And between China and Europe, we agreed to launch this working group. 4 years later, we have developed a few versions of the common ground taxonomy. 2 years ago, it was a common ground taxonomy between China and Europe, which was used to facilitate cross-border green capital flows between China and the rest of the world. And just last month, I think, it was nearly 2 months ago during the COP29, we launched the MCGT, which is called Multi-Jurisdiction Common Ground Taxonomy. There was a joint product between China, Europe, and Singapore. So going forward, we think this MCGT will expand its country coverage and will begin to invite and include more countries to join. In fact, I personally was telling some of the interested countries, including South Africa, Brazil, Indonesia, Australia, and UK, and inviting them to consider joining the multi-jurisdiction common ground taxonomy. And I'm actually welcoming all other countries to consider participating in this common ground taxonomy exercise to continue our push towards harmonization of sustainable finance standards to facilitate easier and low-cost transactions across jurisdictions on green finance. As I mentioned earlier, I'm the chairman of Capacity Building Alliance of Sustainable Investment, which is a global capacity building platform dedicated to promote green finance-related knowledge in developing country emerging markets. And I'm very glad to say that Risk Insight is one of the members of the CASI and is helping us to disseminate CASI capacity building events and efforts in the African region. And in late March this year, we're planning to host a major CASI event in South Africa. And hopefully I'll be seeing you in that event. So in closing, let me thank the organizers of this event, which are Risk Insight and Fusion Asset Management, for inviting me to join this conversation. And I wish this conversation will contribute to the further development of green sustainable finance ecosystem, especially within the emerging markets and developing economies. And let's join our efforts to contribute to the sustainability agenda. Thank you very much.
Following up, we have Mr. Kuben Naidu, former head of Prudential Authority in South Africa, who will be discussing the topic of climate risk in banking for Africa, risks and opportunities.
Hi, good morning or good afternoon to you. I'd like to thank Risk Insights for inviting me to talk on this extremely interesting seminar series and panel. My name is Kuben Naidu. I used to work at the National Treasury, where I headed up the budget office. From there, I moved to the South African Reserve Bank, where I worked as the CEO of the Prudential Authority, responsible for regulation and supervision of banks and insurance companies up until 2022. I then looked after the National Payment System and Financial Stability Department for a couple of years before moving to Investec in the middle of last year. I would now work at Investec, where I'm working on building a corporate payments business inside Investec. I'm going to talk a little bit today about this concept of green banking and capital management in the context of green banking, but from the perspective of a regulator largely. Putting on my former Reserve Bank hat, I also served as a member of the Basel Committee for 7 years. And at a particularly interesting time when Basel III and Basel 3.5 were being finalized, I was part of those negotiations. There's an ongoing and constant philosophical debate amongst regulators about how specific or instructive the regulatory framework should be to deal with a particular issue. Let's take the environment. Should the regulatory framework instruct the financial sector to lend in a particular way or to discourage them from lending in a particular way, be it in an environmental sense or in a social sense? Historically, central banks and regulators have preferred not to be instructive. Historically, central banks and regulators have attempted to set the framework, set a risk framework, set a prudential framework, set a capital framework, set a liquidity framework, and essentially leave it up to financial institutions and the market and their own pressures that bear on markets, including shareholders and the public and society at large, to decide on how they take up or on certain issues, social issues in particular. So I'll give you a peculiarly South African example. There's a lot of pressure on South African banks, both from government and from social stakeholders, for banks to lend more to what I would broadly call the township economy, to lend to people from historically disadvantaged backgrounds. Now, I think the banking sector fully understands that, recognizes that for social stability reasons and for the success of the economy and the long-term stability of the economy and of banks, it's absolutely critical that banks do lend to businesses in the townships, people in the townships, lends to people of a historically disadvantaged background. But the regulator has never gone down the road of saying you have to do this or you shall not do that. Right? The regulator has attempted to use fairly broad policy prescriptions, fairly broad guidelines, and fairly broad directives in order to nudge, cajole, persuade the banks to do certain things. And the banks sometimes willingly do that, sometimes reluctantly do that. The area of ESG has been quite similar, with shareholders, politicians, stakeholders, the public putting pressure on financial institutions to become more responsible, to take more seriously their role as a part of society, and to take account of issues like the environment, like social issues, like governance issues. And I think that that's absolutely correct. The question that I want to deal with today is the arguments for and against whether the regulator should be prescriptive about this and how prescriptive should the regulator be. Let me begin to separate, and I will use the environmental issues, and in particular climate change, as the key example in my talk. But let's separate what I would broadly call adaptation from mitigation issues. Now, it is absolutely important in any financial institution to do sound risk management, to be able to manage your risks appropriately. If we think that it is extremely risky to lend to people who have built houses on sand dunes on the side of a beach or at a beachfront, then it is only common sense for the regulatory framework to insist that banks take adequate account of risk, that banks price that risk properly, and that banks are able to manage that risk. If you have houses alongside a forest and you have an increasing propensity for forest fires, then it is only correct for a bank to take account of that risk, to take account of the increased likelihood of fires, the increased likelihood of losses to the asset. But similarly, if a bank is lending money to an oil company, the bank must say that at some point there may be a risk that society doesn't want to buy that product anymore, either because society is forced not to buy that product or because society on their own free will and volition decides that we want to buy less of that product. And so we have lent to a company, for example, we could have lent to a company that drills oil, and in 5 years' time, there is less demand for oil and you get stranded assets, even though the investment is premised on a 20 or 30-year return. Any bank, any financial institution, and any regulatory framework must force the financial sector to take account of such risks, to price for such risks adequately, and to begin to internalize such risk. There isn't a need for the regulator to be specific. There isn't a need for the regulator to be prescriptive. But there is certainly a need for the regulator to ensure that there is adequate risk management in a financial institution, And that from top to bottom, from the board down to the lowest level person in that financial institution, thinks about these risks, takes these risks into account, and prices adequately for these risks. Increasingly, banks have also seen opportunities, business opportunities. It is an opportunity to make money in certain areas as economies transition towards greener fuels, towards less carbon-intensive technologies, towards renewable energy. There's been a huge boom in renewable energy investment, certainly in South Africa, but globally. And financial institutions have found ways of making money. They do this in many ways. They are able to attract foreign investment. They're able to blend development finance, and they're able to raise capital to lend and to invest in renewable energy, to be able to invest in companies, even maybe oil companies, but they're companies that are actively trying to reduce their CO2 emissions, and companies that are trying to lessen their negative environmental impact. And again, you don't need a regulator to tell you to do this. It's common sense for a bank to do this. It's common sense for a bank to look for opportunities, and there are huge opportunities in that. What has the regulatory approach been in South Africa and, in my view, globally? The regulatory approach has been, A, to insist that banks take adequate account of these risks, that they price for these risks properly, and that they account adequately for things like stranded assets or the risk of stranded assets into the future. That B, there's a common nomenclature, a common set of terms that banks can use in disclosing their exposures in these areas. So disclosure requirements, disclosure frameworks around a common set of terms, nomenclature, has been a second area where the regulators have adopted. And they've insisted that banks disclose certain things, and they've insisted that banks use a common set of terms and a common set of scenarios in accounting for that, so that there's transparency, so that the public can know what the financial sector is doing, and that the public can make their own informed decisions. The next set of issues above terminology and disclosure requirements has been for the regulator to begin to insist that risk gets priced properly, and priced in a transparent manner. And again, this is just Regulation 101. It's not necessarily new. And it's not only with environmental issues. In many cases, there are social risks, there are political risks, there are geopolitical risks. There are governance risks that banks must take account of when they lend to a particular company or a particular industry, and those have to be taken into account. If banks lend money to tobacco companies or alcohol companies or arms manufacturers or certain elements of the pharmaceutical industry, there's socioeconomic risk there. There's political risk that has to be priced adequately and taken into account of. There is an organization called the Network for the Greening of the Financial Sector, the NGFS. The present CEO of the Prudential Authority in South Africa is one of the joint chairs of the NGFS. And the NGFS is a network where good practice, common terminologies, common methodologies, common standards have been put on the agenda to be able to take these things forward. The last issue or set of issues that I'll mention is the risk of what I would call greenwashing, right? The risk where banks and financial institutions essentially lie or pretend that they are doing more about the environment than they're actually doing. And again, I think it's in the regulator's interest to ensure that there isn't greenwashing, and that it is in the regulator's interest to ensure that there isn't greenwashing, because the regulator wants to ensure transparency and credibility of the financial statements and the information that financial services companies put out. So in general, that's been the approach. force the banks to take adequate account of the risks, force the banks to use a common set of terminology and methodologies to price those risks, force certain standard disclosures of exposures, both positive and negative risks that the banks are taken into account. The regulator framework has not moved to a point where they've put specific risk weights on environmental lending. It may get there, it may not get there. I think that there's risks both for and against such an approach, but that has been the approach. It's a step-by-step approach, it's a maturing approach. I do want to say that the conduct of financial institutions in general has been usually positive in being nudged, cajoled, persuaded to take adequate account of climate risk, take adequate account of environmental risk, and to be open and transparent with that. Yes, they can be more transparent, and yes, they can be more consistent in the way in which they disclose that to their stakeholders. But I think in general, it's a positive story. Let me stop there. Thank you.
Next up, we have Dr. Viral Acharya, former Deputy Reserve Bank Governor in India. We'll be discussing the financial stability and economic policy at the time of green transformation in banking.
My name is Professor Viral Acharya. I'm at the New York University Stern School of Business as a professor of finance. Formerly, I've also been a deputy governor at the Reserve Bank of India, amongst other things, in charge of financial stability for a part of the time when I was there. Today, I'm very delighted to speak at this conference of Risk Insight on insights into capital management in green banking. I want to focus in particular on stress tests, climate stress tests that banks are being asked to undertake. What is the general approach to these, and what are some of the important challenges that remain unresolved and that are worth thinking about going forward? Like any stress test, a climate stress test has a scenario, a model, and an outcome. Typically, the scenarios are based on some notion of physical risks, so natural disasters, or transition risk, which is more about changes in policy. Model outcomes would generally then map these into different kinds of risks that banks entail. And then the outcome can either be something that relates to loss or a capital requirement for banks, or perhaps even something that's at a macroeconomic level. In a climate stress test, as you can see here, the scenarios that you have at the top can be quite simple. They may just directly have a physical risk or a transition risk built into them. Typically, you might then model these into losses at the level of loans, mortgages, and perhaps even market outcomes. Now, whether this mapping is entirely direct or is in several steps depends on the specific model. The key aspect of a climate stress test, though, in my view, is not so much the scenarios, which are relatively straightforward to design. No stress scenario is perfect. It is not meant to represent an average outcome. It's supposed to represent something that's in the tail of the outcomes, relatively unlikely, but a plausible risk to financial stability. But it's the modeling from the scenario to specific risks that banks have, which is really crucial. These risks may be market risk, they may be credit risk, it may be liquidity risk, and there might be some second order effects as well. So there could be loan losses, there could be security losses, there could be a loss of deposits. Perhaps the insurance sector gets affected because of loss insurance from physical damages of the type that we are witnessing right now in several parts of the world. And if insurance sector pulls back on insurance, then it could make it hard for the banking sector to make mortgages, and that could result in some losses as well. So this way, this middle piece of the model risk is the most important one. That, however, ultimately has to lead into a net balance sheet outcome for the bank that will translate into some capital requirement, perhaps a liquidity requirement, or none if it is assessed that as of yet there are no financial stability concerns for the banking system, which is also the conclusion being reached in some parts of the world. Now, one aspect of stress test that's very crucial is that usually there are amplification effects. The standard stress test just model the first round of impacts, but as I was mentioning, there could be a loss to the insurance sector who could then pull out of insurance business or raise insurance premia, in turn affecting the quality of mortgages, house prices, ability of banks to make mortgages, and so on. Going forward, it's going to be an important challenge to model some of these interaction effects or second order effects. This shows some of the scenarios that have been used by the network for greening the financial system. This is sort of an informal network of several large central banks and multilateral agencies who are trying to figure out ways to get the financial system to adopt green financing and incentivize firms in the economy to undertake green rather than brown investments, with the ultimate objective of keeping the global warming and temperatures at a reasonable level. As we know, we've just crossed perhaps this year the 1.5 degrees Celsius warming for the planet as a whole. And, as we speak, there are several impacts of that being felt in different parts of the world. Now, in a typical scenario, usually there's a physical risk and a transition risk. If the containment of the temperatures of the planet is on an orderly path, the physical risks may not turn out to be that severe. And if the transition to such a scenario is orderly, then transition risks may not end up being that high as well. As of now, a lot of efforts are being undertaken in the financial system to get things right. Yet many would argue that physical risks have really started compounding over the last decade, especially over the last 5 or 6 years. And transition risks have become disorderly because of changes in political scenario in different countries. And with that, a change in the slant towards climate change and solving the climate change problem. Nevertheless, in my view, these scenarios are relatively straightforward to project. What is not so easy to project is the modeling that comes thereafter. Some of the challenges in this modeling are explained out there. So let's take something like a hurricane. It will most likely lead to property damages. Property damages might be insured, in which case banks may or may not be exposed to losses on the mortgages. However, to the extent insurance is not complete or not present in some cases or delayed, there might be some implications. More importantly, households face an immediate impact from a hurricane damage. They might have to rebuild. They might have to incur additional expenditures. They might require loans from the bank to do this. They might draw down their deposits in order to meet some of their consumption needs. What is the net impact on the balance sheet of a bank from all this is rather complex. In fact, some argue that when natural disasters occur, the construction industry gets a boom thereafter, or that there is an increase in the demand for bank loans. Is this really the case? Is this the case in all scenarios, or in severe enough scenarios, we are more likely to see losses at the bank? But that's the kind of modeling that becomes crucial. And it becomes important for credit risk. A very important dimension there is what's the maturity of the loans. If the loans are coming due right away, then banks are likely to face more losses. Typically, lower income households, those who are not as well financially included in insurance and credit markets, are more likely to default on their loans. Market risk is much more complex. How do markets react to such news? Are their expectations about future accurate? Maybe they are learning with each of these episodes about how severe climate change might be going forward. Maybe climate change is a stagflationary shock. It's going to increase inflation but slow down growth. Maybe that starts getting priced in the markets. It's very hard to tease exactly why the market reacts the way it does at the time of these shocks. Nevertheless, progress has been made on both physical and transition risks to establish that indeed markets are learning about climate change from the events that occur. That our learning about parameters of these models is not complete, and therefore, with each realization, with each observation, the markets are updating their beliefs about where exactly we are in the process of climate change and so on. Now, one very important aspect here is also liquidity risk. As I mentioned, on the one hand, there's an increase in demand for loans. On the other hand, there's also a demand to take out your deposits. Now, if climate change leads to some migratory patterns, maybe there would be a movement of deposits within the banking system from affected locations to the less affected locations. Current modeling is at relatively primitive stages on some of these liquidity risk fronts. Nevertheless, there is mounting evidence that indeed there is deposit migration that is taking place with the realization of climate events. All of this ultimately has to then add up into a balance sheet of the bank. Once again, the horizon at which the bank risks are being assessed becomes absolutely crucial. Some view transition risk as more of a short term risk, others view physical risk as more of a long term risk. Personally, I think climate change is upon us. Physical risks are clear and present danger right now, and so is the political risk, which is creating a great deal of uncertainty about climate change policies out there. Now, as I finish, I want to mention three areas in which banks and central banks can do a lot more work to help our building of financial stability toolkits for embracing climate change in stress tests. First, physical risks and transition risks are not necessarily separate. If physical risks become very high, then it's almost hard for a political administration not to adopt policies to do something about it. So physical risk and transition risk might be intimately tied. Conversely, if it's a political slant that climate change is not going to be addressed, most likely global warming will continue and the incidence of physical risks, natural disasters and damages may keep rising. Within physical risks as well, risks are not necessarily uncorrelated. Many times there are compound climate events that happen at once. If you look at the destruction of the island of Maui in Hawaii a year back, a year and a half back, it had to do with the coincidence of strong winds, a hurricane, and high temperatures, which then led to sprawling fires all over the island. If you look at the current brush fires, which are at work in Los Angeles and the neighborhood areas, unfortunately, once again, it's the combination of wind along with the fires, which is actually causing a lot of damages because it's causing the spraying of the flames all around the neighborhoods. So compound risks, how are climate risks correlated within physical risks, between physical and transition risk? How does political risk interact with all of this is, I think, a very, very important dimension for us to document and understand well. The second area where I would say the banks and central banks need to do a lot more work is in the second order effects. A lot of evidence from many central banks seems to suggest that perhaps the first order effect or the direct impact on banks is not necessarily that large. However, to just give you an example, in many parts of the United States, such as California and Florida, the insurance market for houses has essentially gone belly up. It's become very expensive for the insurance sector to insure homes against the losses from fires, hurricanes, and other natural disasters. They would like to raise the premium, which is a natural thing to happen when these damages are rising, but the state national insurance regulators are not allowing the premium to be raised necessarily. So there is some spillovers into higher premium in other states. But at some point, the insurance industry says this doesn't make good business and they pull out. At that stage, the banking sector now could have a non-trivial impact because house prices could get corrected. It could become difficult to make mortgages and so on. These second order effects are generally very complex. they depend on some critical or threshold level of risks being reached, and then they depend on modeling the exact interactions between different parts of the financial system. Nevertheless, in my view, financial stability should not focus on climate change problem in isolation for banks. It should be in conjunction with other parts of the financial system. Third, and the last point that I wish to make is really about whether central banks should be in the business of climate change policy or not. In my view, this is a very simple question to answer. Does the central bank have a legislative mandate from the elected officials to address climate change? If yes, the central bank should address climate change. However, if there isn't a legislative mandate, in my view, technocratic institutions have to follow the letter of the law that's driving their operations. And it would be very hard for central banks to do otherwise. Nevertheless, in some parts of the world, central banks, even when they do not have an explicit mandate for climate change policy, have gone ahead with proposing that they start incentivizing green transition. The reason for this in some cases is because there is complete political alignment in the region. Take Europe, for example. There's a great deal of alignment between various parties, I would say by and large, that climate change is something that needs to be addressed. There's coherence in the thinking within the different European countries as well. In contrast, in the United States, the two political parties are not aligned on whether climate change needs to be addressed or not. In such a situation, it becomes very hard for a central bank to do something that it's not legislatively mandated to do. This does not mean that central banks, where the political administrations are not clear about whether to address climate change, should do nothing. They can still build models, they can do scenario analysis, they can build capacity in the banking system to understand, model, and address climate change. However, whether they take explicit action or not has got to remain a legislative mandate issue or a clear political direction from the elected officials. Let me stop there. I wish you all the very best for the rest of the conference, and I thank Risk Insights for this opportunity to talk about climate stress tests.
Lastly, we have Anushka Bogdanov, founder and chair of Risk Insights.
Ladies and gentlemen, as we approach the conclusion of this webinar, let me express my gratitude to our esteemed speakers for their invaluable contributions. We began with the former central bank governor of Paraguay, who eloquently shared the current state of sustainable finance and underscored its significance for standard setters globally. His emphasis on the importance of sustainable finance as a cornerstone for the future financial ecosystem set a compelling tone for our discussions. Fusion Asset Management, in partnership with Risk Insights, provided a technical deep dive into their risk framework that is vital for calculating transition and physical risks. Professor Viral Acharya, the former Deputy Governor of the Reserve Bank of India and now a distinguished professor at NYU, enriched our understanding of stress testing and scenario planning for transition risks. Our former Deputy Governor of the South African Reserve Bank, Mr. Kuben Naidu, brought a critical perspective on prudential regulation and reminded us that while regulatory frameworks have yet to fully integrate climate risks, banks are beginning to address this gap through risk pricing strategies. And thank you to Dr. Ma Zhong, former chief economist of the People's Republic of China, whose pioneering work since 2014 has been instrumental in greening China's financial system. Today's dialogue has reinforced a fundamental truth. Climate risk is no longer an emerging risk. It is an inherent and systemic challenge. So thank you once again to all our speakers, our partners, and of course, all of you for joining us today. Let us move forward with purpose and commitment as we tackle this shared challenge. Thank you.
Thank you for your attendance. To contact us or if you would like more information, please send an email to info@riskinsights.co.za.